Hey, good morning, guys. Ken at Tortoise Capital. It is Easter Sunday, April 9th, 2023. Thanks for the good set of questions. This is the Q&A session for the Foundations course. Um, so let me ask Hamad, have you had a chance to see the 2 hour battle drill video?
Yeah, I watched the video.
Okay.
Um,
Yeah,
yeah,
just want to make sure I knew. Okay, so very briefly, for those listening in on this later that may not have seen that belt, that's one of the most important videos to watch. It's maybe one of the top 5 videos. And what this does is put you in a mindset of how to think about a successful trade. I mean, most of the time we think about, or at least I do anyway, making a mistake, losing the money. I wonder what it'll happen, and we spend all our time considering those things, but not about what happens when the trade works in our favor. And in general, what we're trying to do in my style of trading is that there was some pattern from the time we started stalking. The blue line represents stalking. There's some pattern that suggests that there's a good chance for a favorable trade, whether it's a critical state or a mechanical swing or a frog box or something. And typically we'll take a look at the specific price action just short of that, and we'll say, if price crosses that green line, then that's a signal that whatever the hypothesis for the trade, there's some hypothesis we think that that trade should work. And that there's some typical, normal, natural move for it, which says if the hypothesis is true, we should see price action moving in that direction. And I'm going to show this as along. And then there is some a reasonable target to the upside, which is the payoff for the hypothesis. That's the reward. And then there is some price action here, a price level that disproves the hypothesis. Disproves. In other words, this happens, and then the hypothesis is not going to happen because instead of doing what we wanted, it does the other thing. Now, sometimes that is going to lead to a failure pattern. Under certain conditions, the invalidation of the hypothesis in one direction establishes the entry for the trade in the other direction, so a stop and reverse. This is the central idea behind the sniper and the compound critical state, which proposes a very tight little risk box, and then we don't have a directional bias. We're in an emotional zero state, and if it goes long, we're long, and if it goes short, we're short, and the expected reward, or the natural, easy, reasonable reward in both directions is much better than the amount of pain and suffering that we have in the initial risk. So we would, in this case, we think of a risk being small and a large reward in both directions. That way we don't care which way it goes. Very useful in straddles. This happens in every time frame, and the sniper is a specific system that exploits it. So one of the things that we now have to do is to be able to estimate what is the reasonable move that's available, and we should frame that in both directions. Now, it may not be the case that the failure pattern is worthwhile taking. And I'll give you an example. In a bull market, a 5DD pattern, which has 5 lower lows, we would normally set up like this. Mechanical entry 5 cents above the high, mechanical exit 5 cents below, and we're looking for a return to the 10-day high. This is an automatic entry for me. On any of the symbols that I track, a 5DD that comes out mechanically works. And I would normally take this as a unit of risk, being the range risk, and then 2 units of reward back to the 10-day high, and that gives me the minimum 2-to-1 that I wish to see as a justification for taking the risk to my capital here. Now, if the 2R battle drill is one of the most, top 5, maybe the top 1 is frame the trade in both directions. The top 2 is the get to no lose plus dinner for 2. So if I have a stop right here, when I'm swing trading and it starts working, and price is moving towards my 2R, my first and only decision is how soon can I get my risk above the entry in such a way that I lock in this little segment right here so that no matter what happens up in this space, I'm always going to make enough money to take my wife to dinner and pay for the trade. No lose plus dinner for 2. What that move does is changes all of my psychology. It makes me feel like a little scientist who's doing a science project. And the only thing I'm interested in the science project is I wonder how much money my rule set is going to give me, with the worst case being I get to take my wife to dinner with markets money. So that decision is really important because it offsets all of my fears. And now I can just be disinterested. I can be in an emotional zero state. So that one is even more important than the 2R battle drill. But now that I have removed that problem, I now wonder what happens if everything just works out against all the odds. I mean, what are the chances it could work out? That this thing actually goes up to 2R and it hits my reasonable reward. What are the feelings that happen to me there? I don't know if this happens to you, but when I get my way and this thing goes to the reasonable reward, I immediately feel a sense of joy and elation. I said, maybe this is the one that's going to win. Maybe this is the one that's going to pay off my house. This is the winning lottery ticket. It's going to go on forever, and all my financial needs are satisfied. So that probably means I'm a manic depressive, that I feel those feelings all the time. But here's the point I want to make as a professional. If the entire justification for going through all of this elaborate work, all of this, is simply to find a trade frame that gives me a 2-to-1 reward to risk, and then trade it with the right position size, and then actually have it go with a reasonable move to 2R, and then it starts to fail, what should I do when that happens? This should be the most well-rehearsed decision that you ever make, because it's the whole reason for even going into the trade at all. So what happens when it works? I want to be able to handle this decision properly. Now, there's 3 things that can happen when it approaches 2R. So whatever that threshold for 2R is, it's coming, I think of that, it's coming into the train station. It has arrived at its destination. There's 3 things that can happen. One of them is that it blows right on through that and just keeps going. Well, how could that be? We had some price level that we thought was resistance according to our time frame, and we fully expected it to stop there. Well, why do I say that? Well, because a lot of times this is the 10-day high on a swing trade. Or on an intraday trade, this might have been the previous peak of the RL10 or the Dragon, and that was the place where it failed last time, and maybe it failed 3 times right there. So now on our trade, when it's going up there, it comes to that price level. We're not allowed to be surprised if it fails at resistance. That's what resistance means. But we realized that there was enough room to that next resistance that we could get a 2-to-1, so we took the trade. And then we sort of have in this model, we have an expectation that it's going to start to fail. And then we would exit, and we would preserve some or all of the 2R win, and then we'd go look for the next trade. So I'm psychologically ready for that. And I almost feel a sense of relief when it actually fails at resistance, because then I don't feel like I was lucky or crazy. It validates my initial professional judgment that let me identify a reasonable risk. It let me identify a reasonable reward that was in my favor. It allowed me to enter at a logical place. I was able to manage the trade to a 2R win, and it exited in an orderly fashion, and then I get out of the trade. That gives me such a great sense of satisfaction that I can't even describe it. That's how good that is. I never expect that to happen. I try to not be surprised when it happens, but if I'm honest, it's still a little bit surprising when it happens, because that means I'm going to get about a 2R win, and my average win on intraday trades is about 0.7. So all the time I'm framing trades for 2R, and yet my average win is only 1/3 of that. So it's like I'm aiming for 2 and I'm taking 1/3. And I can make money doing that because my average loss is minus 0.3. So when I measure the risk box and the gain box, I'm framing for 2-to-1, and I end up getting 0.7 and losing 0.3 on average. Hey, guess what that looks like? That looks like a 2-to-1 ratio anyway. That's good. It just means that I'm a little quick on the trigger probably. And my win rate is anywhere from 0.6. Sometimes it gets as high as 0.7. I get about a 0.2 scratch, meaning I don't make any money, don't lose any money, or it's no lose dinner for 2 and pays for everything. And I lose about 0.2 of the time. Hey, that's a 3. What's that? That's a 3-to-1 payoff with a 2-to-1 payout. A 3-to-1 win rate with a 2-to-1 payout. So I'll take that forever. In order to get that, if that means that I have to aim for 2, be ready to give up 1, and settle for 1/3 in order to get that, I'll do that all day. And I try to do that all day. So that's an important mindset. Here's the last important mindset that you have to have in order to make the 2R battle drill work. And so if framing it in both directions is important, and getting to no lose plus dinner for 2 is important. Here's the other one that's more important than the 2R battle drill itself. I'm trying to remember. I just had it in my mind and I just lost it. I guess it can't be that important. Oh, I remember. It is that at the moment that I put the trade on and the entry is triggered, I automatically feel the emotion of taking a full 1R loss. I can't do anything about that. No matter how many times I trade, every time that I put that little entry on, I immediately experience the emotional loss of a full 1R loss. Like, there I go, and my inner talk sounds like, dang it, there I go again. Lost that money. Oh well, that's what happens. Well, when I feel the emotional loss of 1R, I'm not trying to feel that. I'm not planning to feel that. I just feel that because I'm a monkey. And here's the psychology. I instantly feel the emotional loss of 1R, and then my rational mind kicks in and says, on average, you only lose minus zero point 0.3, so I've already felt the thing that makes me, in the past, used to worry about trading. I already felt that. And that's the worst thing that's going to happen. So any exit that I take, like if it goes up and then I get out of this thing and my average loss is minus zero point 0.3, if I take that 0.3 loss, I feel like I just made 0.7 because I got 0.7 back. Check. And that 0.7 that I just avoided is also the size of my average win. So when I only take a minus 0.3 loss, I feel as good as I feel when I make an average win. Try adding that to your psychology and see how that goes. Especially if your win rate is 1-to-1, and then on all the ones that you lose, you feel as good as an average win. That gives you resilience and emotional strength that allows you to endure losing streaks, bad days in the market, occasional accidents or errors of judgment. The emotional resilience that you build up from that gives you the strength of emotions to keep trading your patterns, which are positive expectancy, over a long period of time. All right. So that now lets me talk about the 2R battle drill. So we made the entry. We saw the 2R. The first thing that could happen is it blows right through. Surprise? Well, what I have to do with that is I have to know when it gets through 2R, where's my next entry? Because this thing is going to go to the next resistance level and the next resistance level. So that means when I frame the trade in the usual way, I have to take a look at a price ladder so that if it gets through each of these layers of resistance, I'm not surprised. I've already rehearsed that. I know what to do. So here's the general rule of thumb, and this will get to finally Hamas saying, when are you ever going to answer my question? So here's how I start answering that question. There was a time when I earned 60R in a live trading session at the Tharp Institute on an intraday trade in silver. And everybody, including me, was kind of like, wow, that just happened. But when we looked at it, I should have had 120R if I had just been prepared for catastrophic success. This was during a period of time when silver moved all the way up to 50 an ounce, and intraday it moved like $5, and we had like a 20-cent risk on it, so it was just crazy good. Well, imagine that I have 6R in hand, and each one of these is a little win. And what I did was I risked 1R. And what I have now is plus 6. Remember that when I first set that trade up, I was hoping to get 2-to-1. Okay? But instead I got 6. So what happens if I just had an automatic rule that at 6R, I would automatically put another unit of risk on? So I would add a second position at 6R. And just because I'm trading the same symbol, I just use a standard unit of risk. So now, at this moment, I have 6R in hand, and I have 2 units of risk on. Check or hold. And then, what happens if the instant I put that entry on, it immediately moves 1R against me, and I have to exit, and I exit both positions. Okay, that should That should not be a surprise. It can do that. Well, at one moment I was at +6, and now I just lost -2. So my net for that trade is 4R. My psychological monkey mind says, well, you were only expecting 2 anyway, or hoping for 2, but you got 6, and you kept but you came out of the whole thing with 4. You were able to keep 2/3 of your maximum favorable excursion. I have decided that I'm going to feel professional if I do that, because I had an unusually large win. That's almost 10 times bigger than my average win. So I had an unusually large win, and I used one of the units of risk of market's money, and I sacrificed that to get a double scoop, and then it didn't work. Okay, I got out of it with 4. I kept 2/3 of an abnormally large move. That makes me feel professional, like an engineer, because sometimes that'll just keep going. Awesome. Now, here's what happens if I have 10R. What if I did that, and now I have 10R in hand, and I have 2 units of risk on. Now if I add a third position, I now have 3 units of risk on. So I'm +10, and I have 3 units of risk, and that thing moves -1 against me on all 3 positions, so I get out. I got to keep 7 out of 10. So I had an unusually large position. I put the second unit of risk on, and instead of failing, it gained 2 more R. So I added a third position. I was +10, but I get to keep 7. So I keep 7 out of 10. That's a 70% capture rate on an abnormally large position. So that makes me feel professional. So I say that simply to say you must be prepared for catastrophic success. And if you trade in a way that has standard risk, which I recommend, and standard position size, I could now if I put an equal dollar amount on each of these positions within standard risk, it's like I'm putting a poker chip on. I put a chip on, I put a second chip on, I put a third chip on, I get all out because I'm already into abnormal gains. It moved much farther than I had a reasonable anticipation for. So when that run is done, the irrational exuberance is over. I don't want any part of that. I want to clear the deck, get back to the zero state, and look for my next opportunity. So that's why I choose to increment in, and then I exit everything as a rule of thumb for intraday trading. If I'm looking at the swing trade time frame, however, and I'm getting close to the exit, my position size intraday is always larger than the swing trade position because the amount of slippage and the size of the risk is much smaller, usually 5 times smaller. So it may be that I started off with a swing trade, and intraday I had a chance to do turbo, and I put extra load on it, and I'm earning money, but I was always going to get out of most of that position so that the overnight risk is managed. So I'm not talking about that situation. I'm talking about a trade in which you built up into an abnormally large gain. So here is a template that you can use. If you aim for 2-to-1 and you have routine regular risk and an equal amount of dollars, and I'm just going to add a standard position size, then you cannot enter the trade before 2R, because then if you lose an R, you took a winning trade and let it go negative by adding risk. that'll make you lose your mind. So don't do that. You have to have a second position on not later than 6R so that you don't give back too much of the irrational exuberance. That's what I did with that silver trade. I didn't even put the second position on until I had 15R. And everybody and now imagine how excited I was. I was teaching people how to day trade. I showed them how to set up a 2-to-1. We put live money on in the room, and that thing went to 15R with 30 people in the room, and it was being recorded for a home study course. You know how excited I was about that little moment that just happened? Very excited, because I knew a lot of people were going to watch that. And I could feel that. And I was so excited by that, I didn't know what to do until I remembered at 15R, I was like, oh, I probably should have had a second position on with markets money. So I did. And then it kept on going. It went to 30R before I realized, oh, I should probably have a third position on and a fourth position. And by the time we finally exited everything with a great sense of relief, we had 60R. If I had followed just this simple little strategy of 6 and 10 and 12, I could have had 4 positions on, and that would have returned 120 when I finally exited. Check or hold. So one of the things that you got to decide is how much and when, and then your exit strategy in order to decide the position sizing for the 2R battle drill. Okay? And that's on the first one. I make the trade, it comes up to 2R, and it doesn't stop, it just blasts right through. I would say second position not later than 6, and then you can find somewhere in here maybe a way to put on another position and maybe not even take a full R loss. Like if it doesn't work right away, just exit the whole thing. Give it like a timestamp. And you go right now and go, or I'm all out, and then fine. I really don't like the partial exit where I put a second one on, take the second off, and start monkeying around, because then that's the only symbol that I can trade. And I'm trying to get 4 different symbols that are all working in my favor, and I just want to handle them in a simplified way so that I get leverage from using multiple positions on different symbols. So, as my first piece of advice then is, at the 2R, if it blasts right through, you have to put a second position on not later than 6R, and then I'd like you to figure out for yourself where you think, through management and practice and effort, you may be able to put on that second position somewhere sooner than 2R. When you watch me live trading, sniper trade of the day and whatnot, you'll see it often looks something like this. I'll get to the 2R, it works, and then the R10 wiggle happens right away. And so this might be 2R here, and it turns out that this little move was not enough to shake me out of my tight stop. Like as soon as this starts moving through, I tighten my stop up. No matter where it was, I tighten my stop up really close because I want to preserve the 2. Then I watch for the 2R wiggle, or the R10 to wiggle, and if that thing allows me an opportunity to get an entry here before it even takes out the peak, now I have a COTA 2. But I'm only accepting this much risk. And that's never a full 1R. Because I know that if it hits this, I'm going to be all out. So I can actually get this little entry very, very tight. And then if it gets above the R10 wiggle, you will often see me add that position. And 6R might be up here. But because of thousands of opportunities of practicing this decision making, this is now for me a routine decision, only because I know how to manage the non-standard size of the original risk. And that has allowed me to refine my technique. And anymore, all I ever try to do is get that second position on, and I'm very happy. I can do this for the third position or the fourth position, but by the time you have a fourth position on, the size of the little risk box that you have that minimizes the loss on 4 positions is so small that it's a great sense of relief to get out of that position. But I'm very happy nowadays with intraday trading. If I can get a second position on and then exit somewhere up in here, I'm really pretty happy with that. Sometimes you'll see me get a third position on maybe 1 out of 100, and then I'm happy to exit. I'm actually happier to exit than I am to enter because the extra size makes me nervous. So that's what we do if it comes up to the 2-hour battle drill and blows right through it. Not later than 6, and then work on your advanced personal practice to add somewhere between 2 and 6. As long as you can manage a tight risk and never let it go below the tight stop that you've put in. And here's what I do. When I feel like I'm going to put that second position on, I move the stop first. Move the stop first, and then it's locked in. Then add your second position. Half the time it'll fail right away, and you're all out, and you feel good. Because you made the risk management move to move the stop first before you put the entry on. Because what you don't want to do is be emotionally committed, put the entry on, and then it starts failing, and then your stop is down here, and you're trying to talk yourself out of taking the exit. You're saying, well, maybe it'll turn around, and then you watch it come all the way down, and that'll just drive you crazy. So move the stop up before you put the entry in, and then let it go. Oh, here's something else you can do with the sniper trade. Do that on the first exit. When you're trading in a compound critical state, and here's some free chicken, and you're going to take that entry long, put the exit in first. Because if you do it right, this box is so small, it might just fail before it ever hits your entry, and now you're short, and you don't care. You just wanted to take the first breakout of your risk box. So put the one you don't like in first, and then put your entry in here, and then if it comes out of the box, you're long. If it comes out of the box, you're short, and you didn't even have to think. You did all your thinking when it came to finding and framing the box. That's when you do your thinking. But when price moves, you're not thinking. You're just assessing, and then you're moving your stop. If it's long, as soon as you can move your stop to no lose, you're good. Or if you're short, you can move your stop to no lose, and you're good. So everything is execution according to a battle drill. So it comes to 2R, it blasts through, we know what to do. What if it starts to fail? This is where we start thinking in the following way. We had, on the initial, we were risking $1 and we were hoping to get 2. What if this thing gets to plus $1.99 and it starts to fail? And if you were using a trailing stop or whatever strategy, your stop was at 1R. Because you just were using a trailing stop, or 0.99R, let's, call it 1R. So now, there's 1 penny of gain. Oops. And you are risking 99 cents if it comes all the way back. So do you take that exit? Oh, I don't know. What if this now moves 0.1, 10 cents against you? You now are, for a gain of 10 cents, you're risking 90 cents. So this is a 1 to 9 reward to risk ratio. And the only reason the stop was here was not because it disproved the hypothesis, but only because we had a simple mechanical trailing stop. And remember, if you had gotten to 2.0 and then just took the exit, you'd have had a 2R win. And for me, if my average win is 0.7, I have almost a 3 times my average win. I'd be perfectly happy with that. But it didn't hit my target, so now I'm just going to respect my trailing stop? What is the justification for the trailing stop to be there? Does it disprove the hypothesis that this thing is not going to go? So here's what you're really doing. You got to figure out where to put your stop somewhere in here between the trailing stop and the 2R win that gives this enough room to keep going versus preserving capital. Let me make it really easy for you. The first thing you do before that is you say, here's my 2R, here's my entry, and if this thing ever gets above 2R to that level, because maybe this was resistance. Maybe resistance is what caused me to set that as my reward, and then I figured out that, that was my 2R win. But I know that if it clears resistance here this much, the next hypothesis is that it's going to go to the next resistance level. So this is the area that when price comes up and it starts to reverse and I decide to get out in order to preserve my win, if that thing turns around and immediately reverses through, this is my automatic re-entry because it just broke through the previous resistance, and then I'm going to have my standard risk box on, and I know that this is a 2 to 1 to here, so this is an automatic no-brainer re-entry. Check or hold. So now I can put my stop wherever it makes sense to decide how much of my gain to win, because I already know where I'm going to re-enter. So now I'll tell you, you tell me when you want to stop. Gives back 1 penny, 2 pennies, 3 pennies, 4. At some point, you decide that it's more important to preserve than it is to linger, because you already know where your next entry is. And now this gets into the standard framing. Is there ever a time when I want to stop and reverse? Maybe. The longer that I wait, the less reward there is on the reentry. So my point is that as you come to the 2R battle drill, our job is to try to reduce this like to the minimum manageable risk box. And at some point, just take, if you're thinking about it, just exit and re-enter if it goes up and get back to the emotional zero state. So those are all the key decisions that you find in the standard trading. So when do I think about all those? When I put the first position frame in, I'm thinking about what am I going to do at 2R if it goes through, if it starts to fail, and am I going to stop and reverse? 1, 2, 3. Those 3 decisions I'm already thinking about and rehearsing as part of this first trade frame. Why? Because this happens on every single trade I ever take. You know, sometimes it doesn't even, most of the time, it doesn't get to 2R. And I look at, once it gets past my 0.7, it's already an above average trade. That's when I actually start thinking about, when do I preserve? And that whole distance from 0.7 to 2.0, I'm thinking about how to adjust my stop so that I can preserve and then when it fails, it just hits me, and I already know if I'm going to stop and reverse. Usually not, unless it was already past 2R and was an abnormal gain. Or maybe it was a collapsing dragon, and then I want to be short. So those three decisions are all part of the initial trade frame, and that means that you have always prepared and rehearsed all of the decisions that you have to make after you've entered. What are the decisions you have to make after entry? How soon do I move to no lose plus dinner for two? When do I raise that to lock in an average win? What do I do with the 2R? And how do I add a second position? Those four decisions are much more important than the entry decision, which was just I had a compound critical state or whatever pattern, and it made a routine entry, and I got to no lose plus dinner for two. That one is not even as important as all of these decisions, because if you get a good trade, you might make 7 or 8 decisions on how to adjust your stop. So, and then you'll make one decision on how to get out. So you made one decision to enter, one decision to get out, and 8 decisions on how to manage your stop. If you can only be good at one decision, be good at the decision about how to manage and raise your stop so that you feel professional when you leave the trade. Because if you do that right, all you did was adjust your stop all the way up, and then price moved against you, and price made the decision to get out. You don't even make the decision to get out. You just made the decision to adjust your stop, and price made it out. So 9 out of your 10 decisions were exit management. 1 decision was entry management. So what if you found a compound critical state and you let price enter that box, and you just said, look, whichever way you break out of that box, price, you made the decision, not me. I made the decision to accept the frame. And then everything else after that is exit management. So everything is exit management. Check or hold? That's a really big idea. That is the essence of the sniper trading, because we're taking all our standard patterns and trying to figure out how to squeeze the minimum manageable risk box down to the smallest level so that the amount of risk that I take or uncertainty is small compared to a large reasonable gain on the long side or the short side. And if I do that right, I can afford to let price come out of this box, stop and reverse twice, and still be positive over the whole series. So I have reduced my emotional risk by trying to find the compound critical state. Now, is the 2R based on execution risk or position sizing risk? I will tell you, you should do it on position sizing risk. So if if I'm trying to squeeze my risk box down small, on the intraday trade, my target is the range stat, which is the average range plus 1 standard deviation of that, which is a frog box, is 1 standard deviation of the average range of the last 30 days. The MMRB that we use now is by definition 1/10 of the range stat. So that gives me 9 potential rewards again. That's almost 10, right? So if I'm going to use math and say, if I take a -1R loss on an MMRB, I'm going to set that equal to a 0.2 loss mathematically. And what that means is that I have, instead of taking a full, I'm only taking 1/5, I'm actually getting essentially a 10 to 1. And my position size is based off of 2 position sizing risks. You can do that easily intraday. On a swing trade, that's a little harder to do, because even if I used 1 times ATR as my risk box, like 5-day down, maybe my range risk is this tiny little thing because it was a doji. That's good. And maybe the 1 ATR, maybe the doji that I'm using is 1/4 of an ATR. That means my 1 ATR is 4 times larger. So I want to be able to see 2 ATRs of potential gain against 1 unit of risk for the ATR. But I'm hoping that the doji was much smaller than 1 times ATR, right? Hey, what if the doji was large enough that it was like 2/3 of an ATR? Then maybe I should pick 2 ATR as my position sizing risk, so that when I take a routine exit, I'm taking less than a 1R loss. Or I should put it this way. Yeah. I like to take fractional losses, because then it just feels like I lost a poker chip. And when I look at the trading histogram, the very first thing that I look at is, did I ever take any losses greater than 1R? If so, then there was something wrong in the way that I was calculating my manageable risk. I believe that I can set and then manage a 1R loss. If I traded this pattern 100 times and I had 0 losses worse than 1R, I then say, well, that's good. I manage the risk. What about on the positive side? There's 2R. Do I have positive expectancy between 1 and -1 and +2? And then the third thing, if that's true, then all of these trades pay for everything. And then do I ever have trades greater than 2R? If so, that's just like cake. It's a dessert. It's good to go. So, that's everything I wanted to say about question 1. Fair? Question 2, market type for FX. What we generally do is we take a look at the 24-hour periods, and there's really 3 8-hour periods when one of the sessions comes online. And what we do is we look at the performance of each of those sessions to decide what is that market looking like. That turns out to be better, because each time that one of the new offices comes online, you get a lot of scrambling around, and then it gets orderly moves, scramble, orderly moves. So we do one of 2 things: treat it as an 8-hour session by itself, or if we're trying to do market classification, look at the similar ones. And what I do for market type on FX, I really just look at the slope of the RL30 and the MACD histogram, and that's all you need. The seasonality of the MACD is enough. Frog boxes. So the frog box is based on the average range of the last 30 days, the standard deviation of it. So what we do, the frog quality number, is you take the average range and you say how many frog boxes are inside. If you can fit 3 frog boxes inside the average range, that means the range has been so consistent that the size of the standard deviation is small, and you can fit 3. So if I could use a whole frog box as a risk, an average range gives me a 2-to-1. That's good. And it turns out that if I take the range stat, which is the average range, plus, and I take 1/10, I get an MMRB. It turns out that a standard frog box is equal to about 3 of the MMRBs. So if the MMRB that we use, 1/10 is too tight to manage, just use a frog box and trade it at 1/3 of the normal dollars at risk, and that way you have the same risk exposure but a wider stop. And then your job is to reduce the hybrid frog box starts trying to trim down the size of the frog box till you can work your way down to 1/10 of the range stat. Your job is to try to reduce the size of the risk that you're taking so that you can get to no lose plus dinner for two faster, so that you can increase the size of your R multiples, and then you'll find some happy trade-off that it feels good. If you make it smaller, it's too tight. So your job is to try to reduce it down to that level. And you'll end up, I started with frog boxes for my mechanical intraday swing, and now I'm down to 1/10 of the range. So I'm down to about 1/3 of a frog box for routine management. It just takes time and practice to do that. And remember, if I can get to 0.3, I used to be, and I still am happy if I can enter after it has moved off the bottom a full frog box. Guess what happens? At the place where I used to be happy to enter, I now have a 0.7 win, and that's my average win. So you get paid off in the long run to be able to reduce the size of your risk box. Next. And I'm only hurrying now because in 4 minutes I got to start the creativity check-in. But these ones were actually easier to answer. The VWAP, what is it used for? So at the close of the day, in the open of a new day to the close of the new day, price moves all over the place. When you take the number of shares times price, you get an average, a volume-weighted average. And that's going to look something like, it should be orange, sorry. It's going to look something like this. Because as volume goes down during the day, each of these price moves only is nudging it a little bit, because volume is declining. Each of these bars is low. So VWAP later on during the day doesn't change that much. What you notice is that price moved way up here, and guys that are doing that are using leveraged positions to get more and more of a big run, but they have margin calls, and they have to be out of their position in this amount of time. So that means after they get as far as you can go, it's not unusual to see it come right back to the VWAP, and we call that the VWAP magnet. So always know how far this thing can fall. There might even be a trade in there. And know how much of the money you have. If I got in here, I have this much in hand, and I know it could come back to the VWAP. Man, I don't want to, I got to be careful later in the day. Outside of the day, the VWAP kind of disappears, except to say, go look at the market profile. Look that up on Investopedia. Every day the market closes, there was a high, there was a low, and there was a close. There's also some price level that was the volume weighted average price. It's usually pretty close. And that, until price breaks out of this range the next day, maybe it opens here. This market profile, the previous day's point of power, acts like a big magnet to pull price back to the fair value. Long-term traders and brokers pay attention to the VWAP because in their world, that is how they manage their gains and losses of the broker. The trader says, hey, broker, I want to buy Microsoft at an average of $100 a share, and I need you to buy me $20 million of Microsoft. If they just went into the market and bought it at the bid, that would drive the price way high, and he could never get it for $100. So what they do is they start buying and selling and doing their little tactical trading, and then they compare their average price against the accumulated VWAPs of all those days. And if the trader is able to get a price better than the average VWAP, they get a bonus of something like, they negotiate a bonus for excellent performance. So he gets not just the brokerage fee for executing the trade, but he gets paid for excellent trading by getting an improved price. And then the guy who gave him that money is willing to give him the bonus because he got better than his happy price. Check or hold? So the VWAP is used intraday for us to manage an intraday fair price, and we use it to protect gains. And then it also is, look, if VWAP is rising, I want to be long. If VWAP is falling and prices below the VWAP, I want to be short. So it gives a little ideas into seasonality. And now your last question was, there's no parameters on VWAP. It just is a pure mathematical feature. And then the MACD seasonality on TradingView. I don't use TradingView, but remind me to send you a note to Jeff Boccaccio, or if you just go to rfactory.io and send a note to Jeff. If it's not programmed into TradingView, I know he can do it. Was that your question, was how to get it on there?
No, I spoke to
Oh,
Jeff already.
oh, okay.
Yeah. And he has the indicator on sale, but I saw some other students that have it. I just
Oh,
didn't get a chance to go to speak to them.
oh, okay, yeah. Yeah, and then let's see, MACD seasonality, I think you've probably seen it. There's a zero line, and we have it set by default to 10, 30, and 5. Although for swing trading, we have been exploring 8, 30, and 5, and that actually looks kind of good for swing trading. But the interpretation is always the same. When the signal line goes below 0, it's winter and you want to be short. When it gets to the peak and starts to go up, this is spring. You can begin to enter swing trades, or even intraday, you can begin to enter initial positions. When it gets above the 0 line, you want to have been long by there until it peaks. And in the fall, you're looking to preserve gains. And then if you see summer, fall, summer, this is an automatic long. It's like a kata 2 on MACD. And if you see winter, spring, winter, you want to smash that to the short side because it's like a collapsing dragon on MACD. But this gives you a general feel for how to interpret it. And then if you look for Tim has a video in the Foundations course where he briefed that extensively, and the impact on his swing trading was astronomically good. It works on every time frame. Check or hold? Okay, that's everything I got. I'm gonna we're gonna roll it over into the Creativity 202 standard debriefing. You guys are welcome to listen in if you like. This is a gift for waking me up an hour earlier on Easter. Really? Is that what you did to me? Okay. No, I need to close the room real fast so that it starts processing the recording, and then I'm going to restart the room right away. So to Jeff and Ernie, I'll be right back, and we'll see you guys. Thanks a lot for your question. Hopefully you found that helpful. I'll get that recording posted into the Foundations for you to kind of review. But that opening maybe 45 minutes was absolutely essential. It's not just the 2-hour battle drill, but the 2-hour battle drill leads you to those 5 beautiful ideas that you sort of have to take all together as part of the psychological professional stance, if I can say it that way. Okay? So thanks very much for the good question. And then if there's additional follow-ups, just send it to me in writing, and we'll just keep going until I can explain it better. Okay? So that's everything for this one, and then I'll see you guys next time I see you soon. Okay? Cheers.